I think a lot of it's missed opportunities. And one of the things I see the most is either missed 1031 exchange options or even messing up there's very specific rules either for a 1031 or reverse 1031. And so sometimes, not clients I'm working with, thank goodness, but sometimes I have clients or prospects come to me and they say, oh, I just did this thing and I think I want to do a 1031 exchange, but they've already gone too far down the process to meet some of those rules.
What if the biggest wealth mistake you're making isn't in the stock market, but in your own backyard? Today on the Real Estate Roundtable, we're diving into a conversation that could fundamentally change how you think about money, property, and legacy. My guest is Susan B. Jones, managing partner of Sorrell Wealth Partners, a fiduciary fee-only wealth advisory firm dedicated to helping women navigate major life transitions with confidence and clarity. With over 25 years of experience spanning international law, national accounting, and a top 100 registered investment advisory firm, Susan has seen firsthand how real estate can either build generational wealth or quietly destroy it. We're talking real estate strategy, tax traps investors miss, estate planning mistakes families regret, and how properly ownership plays a critical role in financial independence, especially for women navigating divorce, widowhood, or reinvention. If you care about building wealth the smart way, protecting it legally, and passing it on intentionally, this episode is for you. Welcome to the podcast, Susan.
Great. Thanks, Lancelot. Thanks for having me.
So, Susan, before we get into strategy and tax planning, I'd love to understand the beginning of the story. You started in law and tax. What was the moment you realized wealth management was where you were truly called?
Yeah, it's interesting. So there's so much overlap in tax and estate planning and wealth management. And if we back up, I've always loved math, but also really interested in psychology. My father was a financial planner. My mom was a social worker. So I have a nice blend of the two. And so I just naturally progressed to really wanting to be with clients to see the whole picture and to be in the room and with them as they were making a lot of those really important financial decisions.
That's awesome. Situation that's shifted your direction.
I had a client probably starting about 13, 14 years ago who really brought me in as someone to bounce just all kinds of things off. Sometimes it was even family dynamics, wealth management, tax. And I really started as their tax accountant. And so that was, I think, the relationship that made me realize this is really what I want to do for all of my clients.
Was there a gap that you saw in traditional advisory firms that led you to this?
Yeah, there's a lot of great advisors, but like I said, I think there's that intersection of tax and estate planning and investment management that without understanding the full picture, so much can get missed. And the problem is a lot of times those missteps, you can't undo them. And so that was really what made me just really feel very passionate about this.
And why women specifically? Tell me about that.
Yeah, women are oftentimes underserved in a way, either that they're excluded from conversations, not because they're not bright and capable, but just because they either don't have the natural relationship with the advisor or because it's seen as, oh, it's easier to do it without her. And a lot of times, even if the woman is in the room, if it's a couple, I kind of joke and say that she's not treated as one of the main characters. And maybe sometimes she's either talked down to or things aren't fully explained, or she's really there to be informed as opposed to a decision maker. And seeing that throughout my career, that really made me passionate to being more intentional about reaching out and working with those women. That being said, I also have a lot of couples and even single male clients. And so I always got to get a chuckle. Just back last week, I have a new client that saw the website, saw the women, and didn't hesitate to click through and contact me. So
that's good. So founding Sorrell Wealth Partners wasn't just a business decision. It was a mission.
It was. And again, it really goes back to, so I've had the honor and the privilege of being an owner and a partner and decision maker with a lot of really large, successful organizations. And it's been a great experience. But I realized, along with my business partner, Sarah, what we came to realize is that we really wanted to be very deeply involved in our clients' lives. And so we didn't want to do a lot of the delegation that's required at a really large firm and really wanted to have that more personal boutique feel. There's also been a lot of kind of movement, new options in the investment space. And so we were able to partner with a registered investment advisory platform so that we still have the institutional grade investment advice, all of the client service aspect that make a really good client experience.
Oh my God. Sounds like something that is really interesting for us. In real estate, we often hear real estate builds wealth. But from a fiduciary perspective, when does it actually build wealth and when does it quietly increase risk?
So I have a lot of clients who love real estate, and real estate, as Lancelot, can be an incredible wealth builder, partly because of the ability to leverage and to get the appreciation, all that great stuff. But what I've seen time and time again is when a lot of real estate investors love real estate, or even just if it's the family home, that there's been over leaning into real estate without necessarily thinking through all the repercussions. So sometimes what I see is clients who have been successfully investing in real estate, but what they don't feel is wealthy, even though their balance sheet shows that they are. And what it is, they haven't done enough cash planning. They haven't diversified, which is so important in any comprehensive financial plan. And so they've gotten themselves in a situation where their cash flow isn't as flexible as they would like. And sometimes even they haven't done that longevity planning to think about what comes next, especially when they're really active real estate, either investors or developers, that it really does take boots on the ground and they haven't, again, thought through what that next step looks like.
And how should someone evaluate a rental property within their full financial plan?
Yeah, there's looking at the rental property itself, obviously, and being very thoughtful about what the ROI really is. And again, I'm sure you've seen it too, where there can be a tendency towards sometimes being a little too optimistic, especially with maybe the first few real estate purchases where you're not necessarily building in the unexpected maintenance or what happens when the roof collapses and you have to replace that. And so really making sure, and even tenant occupancy, that's something I sometimes see that hasn't been factored in. So first it's just doing the fundamentals with the actual property. And then it's really looking at what does this mean to me in terms of my full financial picture. And so again, am I diversified? Am I doing the retirement planning that I need to do? What do my other assets look like? Again, if I do have an emergency that I need more of a larger cash influx, how am I going to be able to do that? Am I getting over leveraged? That all of those different questions that, again, I think it can be really easy, and especially when a good deal comes up and you want to move fast, to gloss over those until it becomes an issue. And that's where the risk then can get heightened.
Got you. And how much of someone's net worth should realistically be tied up in property?
So I'm going to say 25 to 35% at the most. When we're looking at what a concentration risk. So if you came to me and you said, hey, I did this great thing, I bought NVIDIA back when it was great. Even then I would say, Lancelot, to the extent you're getting more than 10, 15%, you have some concentration risk. Real estate's a little bit different, I think, especially if you're adding in kind of a family home or a second house. But once you get past that 35%, you really are pretty heavily concentrated. And so again, the answer is never, oh, we just need to sell everything, but to me, that's when you really need to have a thoughtful approach and make sure that your other assets are enough to support and give you the flexibility that you want and need.
This is a really good question. The next one. What are the opportunity costs investors ignore? I think about this a lot of times, and I try to explain it to my investors that don't just look at the purchase price and how much rent it's making, because it's more complex than that. Could you elaborate on that for me?
Sure. A lot of times, again, when we're looking at the ROI and thinking through what that return is, what people sometimes fail to think about is, if I wasn't doing this with my money, what would I be doing with it instead? And so whether that's investing in the stock market, which obviously has had, I think as we probably all know, has had a few great years here, or doing other type of investments, every time you realize, every time you think through and analyze what you're doing with a dollar right now, you really have to be saying, but what would I do otherwise? And that sometimes, especially when I see younger investors and they're getting loans and that can in some ways be, if you're not going to trade on margin, which is risky, and I'm not at all saying anyone should, but it can sometimes almost be like a forced savings mechanism. But then later on, when there's maybe different opportunities with that same dollar, you've already invested in real estate, that's when some of those opportunity costs can really be pretty significant.
I always look at it in this way. You have a property, don't just look at it as a property. Yes, it gains appreciation year after year, more than likely around 3 to 6%, except for some years, but most years it does. But besides that, you got depreciation, you got a write off on your taxes, you got maintenance that you could write off. So you should just look at it as, oh, bottom line, this is how much I'm making. Yeah, you're making money with a rental, but at the end of the day, all these other things factor into actually what that property is doing for you
Yep.
in the grand scheme of things. So yes, your portfolio is 25%, let's say real estate, but it's helping with the other gains that are happening in the stock market. Let's say you had a big win and you made 100 grand on selling Nvidia. Okay, we're talking about Nvidia.
Yeah.
You got to offset that income you can offset that income with some of the expenses that you're acquiring or having with the property, which is awesome in the grand scheme of things.
Yep.
And I think that's why real estate should be one of your anchors for investing and growing wealth.
So I agree, but that's also where that tax planning at the outset as opposed to later on, because what I also see is sometimes someone says, hey, I'm an executive at this big company, but I read this article and it said I can invest in some properties and get these great tax write-offs, and oh, that's great. But then when we start looking at it, they don't cross that threshold into if it's a longer term property, being a real estate professional, or if it's a short-term rental situation, they don't even cross the barrier into getting to that non-passive category. And so that's where so I agree with you. And there can be, again, some great benefits to real estate, and especially in that situation where you have some ordinary income even to offset, but making sure that you understand the rules and that you factor that in, because that's where some big surprises can happen, unfortunately, when there's these losses that were expected to be able to be utilized. And then it's sometimes the advisor or the tax accountant that has to give that. That's a difficult conversation to have. I've had to have those, and they're not fun.
Oh, for sure. What does true financial independence actually look like on paper?
Yeah. So it's really, I think of financial independence as the threshold that you get to where you can say, I can change my mind or I can walk away and do something different. And so again, and there's ways that we do that in a very kind of quantifiable way and with planning and modeling and things like that. But to me, that's where the true financial independence is. It's not, we used to talk about retirement planning. The reality is, and I'm sure most of your real estate investors too, most people that I work with don't have that day. They love what they do. They've been successful. They don't have a day where they're like, hey, I'm just going to go lay on the couch. But they do say, hey, I have some passion projects, or I want to step back and spend more time with family or different things. And so that's really that independence piece and why it's so important.
It is. What are the biggest real estate tax traps investors fall into?
I think a lot of it's missed opportunities. And one of the things I see the most is either missed 1031 exchange options or even messing up there's very specific rules either for a 1031 or reverse 1031. And so sometimes not clients I'm working with, thank goodness, but sometimes I have clients or prospects come to me and they say, oh, I just did this thing and I think I want to do a 1031 exchange, but they've already gone too far down the process to meet some of those rules. So just making sure that you're watching for that, and also understanding so especially how it relates to vacation properties. So I've sometimes had clients that have a vacation property that has a lot of unrealized gain, and they want to make some changes and we get a new property, but no one's really using it. There's all these different things. And there's some really good opportunities to convert that property into investment property for a couple of years, do the 1031, keep it an investment property for a couple of years, and then make it a vacation home again. But that's something that I often see get missed too. And then just some record keeping items. I'm always amazed at how many times people miss different improvements and different things. So that additional depreciation opportunities, I often see those get missed just because of record keeping issues.
And passive loss limitations.
That's a big one too. And that's where too also that record keeping comes in, because it's so hard. Sometimes it's a year later by the time that you're sitting down to do a tax return and talking with your accountant. And so then the questions about how much time did you spend? And so there's some very specific rules around that, and being able to really quantify that and feel good that if you get challenged by the IRS that you can support it. And so making sure that if you're a real estate professional, that you're tracking those 750 hours. If you're doing the short-term rentals, at least making sure that if it's the 100 or the 500-hour requirement, that you understand what those are and that you're tracking them. Because that too, it can be really hard to go back and try to sketch that out later.
Improper entity structuring.
Yes. The biggest thing I see here is, especially with people who have had real estate for years and they have something that they bought 30 years ago and they haven't checked the title in a long time. I had a client who the parents were big real estate investors, had a really nice, successful portfolio, but had been real estate investors for 50 years. And at the second death, going through some trust administration, and came to find out that there was a kind of a distant family member who was on the deed to one of their really largest properties. And the fallout from that, I mean, we could have a whole episode just on that. But the reality is no one knows how it happened. But at some point, this man had been added to the deed, never involved, all these different things. And that's obviously doesn't happen. That doesn't happen all the time. But I'm always amazed at when I have a client who tells me how something is structured, and then we dig into it and realize that either it never got transferred to the trust, or the LLC never really got formed, or there's no agreements in place. And so just making sure that you're dotting the T's or dotting the I's and crossing the T's and all that is really important. And then just following through on that. And again, making sure you have all the documentation in place. If there's multiple owners, making sure you have either a buy-sell agreement or something else in place on what happens when there's an exit. So again, a lot of it's just that business structuring to make sure that things don't fall through the cracks.
How about capital gain surprises?
So especially with depreciation. So a couple of different things there. I think sometimes we forget that if we take depreciation, that then if you go to sell it at a gain, there could be recapture either at a 25% rate, or even if you've been able to depreciate some personal property, an ordinary income tax rate. Still, oftentimes much better off being able to accelerate those deductions earlier. But then again, it can really cause a surprise later when you go to sell. The other thing I see a lot is we're so lucky in the state of Florida that we don't have state capital gains, but I have many clients that have properties all over the US. And so what they forget is that even though we're in Florida, that when they go to sell their property in whatever state it is, if they have a tax there, they're going to end up paying that state income tax. And so that can also be an unwelcome surprise.
And what hidden costs silently erode long-term returns? Talking about insurance, maintenance, vacancy rates, refinancing risk, lifestyle creep.
Yeah, you named it all. That really is. And especially, I think, those non-recurring expenses. So again, if there's some kind of major issue that there's going to be out of pocket for, that can be both surprising, but also I'm always amazed at how many clients that I work with that don't want to build that into the kind of their normal bookkeeping or performance reporting. And really, that's part of it. The other thing is, again, the rates, the occupancy rates. That's something too I see a lot of times. People think, even when we all know that there's oftentimes between tenants to do repairs and some refreshing, but I oftentimes see when we're doing kind of projections built in that the property is going to be rented all the time forever. And that's just not realistic.
No, it's not. I can attest for that. I know. I own rental properties. If someone owns 3 to 5 rental properties, what's the one financial review they should be doing annually?
I would say look like a comprehensive financial review where they look and they say, okay, I have my properties, but what else do I have? And so do I have retirement accounts? Do I have stocks and bonds? What is my asset allocation? To your point earlier, Lancelot, with the returns on real estate, I oftentimes consider them almost like fixed income. And so when I'm looking at a client's overall asset allocation, I'm saying, okay, you have your fixed income, and certainly there's appreciation on that as well. But what do we have that looks more like an equity? And so I think that's really, to me, that the most important part. And then also just, again, looking at each property and asking yourself, is this performing the way I expected it to? And if not, is that a short-term issue? or is it a long-term issue? And if it's a long-term issue, does it need to be either swapped out for something else or some other kind of change made?
When families inherit real estate, we often see conflict. What's usually missing in the planning stage?
Lancelot, so do you say conflict? I apologize.
Yes, so when families inherit real estate,
Yep.
we often see conflict.
Yep.
What's usually missing in the planning stage that causes that conflict?
Yeah, so a plan. So one of the things I see most often challenged, and I shouldn't say challenged, but where there's the most conflict is with a vacation house. I have many clients through the years that have had a vacation house somewhere. It's been the scene of many family memories and everyone feels very attached. And usually the next generation, once it gets large enough, it's usually people of all different, whether they want to use it, whether they don't, whether they have their own funds that they can help maintain it, all these different things. And so the good news is there's some great ways to plan around that. So creating an LLC, creating some trust, some rules around how everyone uses it in a very kind of systematic method, all these different things. But that involves having a plan. And so oftentimes I see that there's been no plan created, and then it's the next generation that really has to come up with their own plan. And that can be really challenging.
Got you. So basically create a trust that shows you the guidelines of how to properly use that property.
Yes.
That makes a lot of sense in that matter for sure. How can families protect property across generations without creating division? And that was the answer to it.
That was, yeah.
Yeah.
That was.
Pretty much.
Yeah.
Setting up the trust with the guidelines.
Yeah.
What's one estate planning step every property owner should take this year?
I would say, again, reviewing titling and making sure that everything is, all properties should be in an LLC. The LLC owners should be consistent with their overall estate plan. So again, I strongly recommend revocable trusts if there is an estate tax issue. Now the estate tax exemption is 30 million for a married couple. So it doesn't apply as broadly as it used to, but still we're all optimistic, right? So in that case, looking at whether it makes sense to do gifting and do an irrevocable trust structure. But if nothing else, having a revocable trust and making sure that titling is consistent with that.
So you specialize in helping women navigate life transitions. What financial mistakes are most common during divorce or widowhood?
Oftentimes, either acting too fast or acting too slow. And a lot of times that revolves around being overwhelmed and making decisions from a place of just wanting to get through it and get it passed. And I see that really both with divorce and widowhood, that oftentimes there's a real desire to move on and to put all this behind you, but that can really impact making very intentional and structured decisions when it matters the most.
Should women prioritize liquidity or property?
I'm going to say both. Again, I think it really does need to be looked at in terms of the whole financial picture. And liquidity is great, but oftentimes what I see is, particularly in the case of divorce, that there's a little bit too much of an emphasis on what this is going to mean right now without enough longer term planning. And so real estate can really be a great way that both provides current cash flow, but also then provides options later on. And again, I think it really is important to look at both of those and to take a breath and not to make decisions that are really just meant to get to move on.
And how does property ownership change financial confidence?
That's a really good question. Sometimes what I see, especially in the case of, but really divorce and widowhood, that it hasn't necessarily been, and again, usually I'm working with the women in that situation, that they haven't been the main kind of drivers of that ownership. And so that's oftentimes a time when there can be a lot of overwhelm and the thought of, I can't do this, so I just need to liquidate and move on. And so I think really understanding that there's options, there's good property managers, there's something that can be learned. A lot of times the same women that are like, oh, I couldn't possibly manage this rental property, they've been running their own household and managing all the repairs and all of that. And so I think really thinking through, is it something I can do? And oftentimes the answer is yes, you've actually done this. It's just been in a different context.
Well, the honey-do list goes to Mr. Handyman now.
Yeah, exactly. But some ways it's great. We can really tell them what to do.
Exactly. You can pay them for it. So it's, I got this. And it's not going to take 3 months to do.
Yeah, exactly.
What mindset shift is most powerful?
Just, I think that thought that I can do this, and also you don't have to do it all yourself. And I think once you embrace that there's people that can help you, whether again it's a property manager, whether it's a financial advisor, whether it's an accountant, but there are people that we spend our whole life doing this. And so just like there's certainly things, I certainly depend on medical professionals and things where, that's not my wheelhouse. The same is true for property ownership, that there are people that you can consult to help you.
What does financial freedom mean to you personally?
Yeah, I would say it's the same for me that I think of with my clients, that it's just that ability to say, hey, does this what I want my life to look like? And if the answer is yes, great. If the answer is no, that you have that flexibility and that freedom to make a change.
So next round is the rapid fire round. Questions are not that short, but I would like a short answer for them.
Okay.
Okay. Real estate or stocks? If you had to choose one for long-term wealth.
Stocks.
Biggest money myth people still believe.
Oh, investing in individual stocks, that you can pick a winner.
Oh, yeah. Guilty.
I know. It's a hard one.
Yeah.
If it worked once, it's hard to, move on.
Go, ETFs. One financial habit everyone should implement immediately.
Doing a financial review, whether it's yourself or with an advisor.
And what should listeners ask their financial advisor this week?
How often they've had or how recently they've had a review.
Okay. So you can connect with Susan on her website, which is
www.sorrellwealthpartners.com.
And on LinkedIn at Susan Wolford Jones. Wolford. Sorry about that. I butchered that one. You could. It's going to be down in the show notes at the end of this podcast. Susan, this has been one of the most important conversations we've had on this show, because buying property is one thing, building lasting wealth with it is something completely different. If you're listening and you want clarity around your real estate strategy, your tax planning, or protecting your family's legacy, I highly encourage you to connect with Susan at Sorrell Wealth Partners. She offers a complimentary meeting, and she's also working on a book coming out later this year, so stay tuned for that. If this episode gave you value, share it with someone who needs to hear it, especially a woman navigating a financial transition. Make sure to subscribe, leave us a review, and we'll see you on the next episode of the Real Estate Roundtable. Thank you, everybody.
Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.